Transneft. So these sanctions are having incremental impacts already. The embargo, of course, would be the biggest one, but it's not a short-term impact on the market.
I suppose that's my sort of sense of it when I sort of tongue in cheek say it doesn't matter anymore, but it's really the way the train has left the station. BP has left Russia, Halliburton's left Russia, Vitol's left Russia. The impact of this breakdown, this fracture in Russia-Western relations is now baked in the cake for the next 3-5 years. And so the impact of the embargo, whether on the front month or the immediate, may be something to look at. But ultimately, the embargo has really already happened from the point of view of mid to long-term Russian oil production. I'm wondering your thoughts, just looking out the horizon a bit on that point. What could be the impact of what's already in the train that's left the station, so to speak?
And I think that's exactly the way to put it, right? The embargo will be a headline. And of course, it will accelerate Europe, really pushing towards zero of that Russian oil imports. But the reality is we've already seen self-sanctioning by European companies. We've already seen Europe reduce its purchases by almost 600 to 800,000 barrels per day. Remember, right here, right now, there are no sanctions on energy. And we've still seen that kind of a decline. Europe used to import about 3.2 million barrels per day of total oil or crude oil from Russia. Right now, it's probably importing about 2.2. It's close to 1 million barrels per day lower. And that number will probably go towards 1.5 million barrels per day lower, even just by June. And like you said, for the medium term, the companies that have left, pretty much all Western companies, particularly the service sector, which is so important for Russian production, it does mean that Russian production is not going to grow in the medium term. We are already in a very constrained environment when it comes to oil supplies and spare capacity. Russia was going to be one of the few countries that was poised for some growth in the medium term. Now we think Russian production will be 1 million barrels per day lower than pre-COVID levels in the medium term. And we are being extremely generous. We are basically making the assumption that Indian and Chinese companies will step in and help out, but their technology is nowhere close to what Western technology is and what Russia needs. 90% of Russian oil is very high water pressure and high water cuts. So that does require Western technology. So again, I'd say we are being conservative. I've heard estimates of as high as 2.5 million barrels per day that Russia loses in the medium term. And exactly like you said, I mean, the train is already in motion. Any further sanctions will accelerate that movement. But the ultimate kind of the writing is on the wall. Yes, it might not be as dramatic as the West hopes for because you've still got support from India and China. But yes, you are going to see some significant drops in Russian production.
If we look a little bit closer to the time frame, obviously we're midway through the second quarter, 3 months literally to the day in this invasion, this war on Ukraine. Russian oil is still making its way to the markets. It's obviously disrupted, but not massively so. How do you see the next 3 months of the conflict? Obviously not the conflict itself, but the immediate impact for the oil markets and sort of supply and demand vis-a-vis the impact of Russia?
So I'd say the big things to watch out for the next 3 months, very much around the shipping sanctions that I just mentioned, because that kicking in will mean even less oil flowing from Russia. We've obviously seen India in particular buy a lot of Russian oil, particularly the private sector guys. And I think that could change. And we're seeing that in some of the loading numbers already, because that oil was being moved by trading houses like the Vitols and the Trafiguras of the world, who have now dramatically reduced dealing with Russia after the 15th of May sanctions kicked in. You'll probably get India still buying a lot, but slightly less than what we've seen in the current 3 months. China, however, probably steps up from here. We've seen China kind of being on the sidelines on when it comes to Urals, at least, because again, it's been battling with COVID. ESPO is still flowing to China. We think that will continue. Even the so-called that gets backed out from Japan and Korea will flow to China. But we do expect some more Urals to potentially flow to China. So net, like overall, we could see about 1 million barrels per day of Urals between India and China taking it. And then ESPO is about, like, let's say, China continues to take its 1.5 million barrels per day of other Russian oil. That doesn't really change. But we still are talking about 1.5 million barrels per day of Russian oil not finding a home. Right now, it's been going to Asia, just floating off Malaysia, and in the hope that it will find a home. But that is going to get incrementally harder without trading houses and without shipping insurance. Now, the one thing I will mention is we've seen a lot of small shops pop up, in particularly the Middle East, in Dubai, for instance, Russian companies, and they are helping to move a lot of this Russian oil to Asia. So that will provide some offset. But yes, I mean, I think it's not going to be a one for one for sure.
Is there the storage capacity in India, China, Asia to take advantage of this heavily discounted Russian oil? We saw in 2020 the Chinese take advantage of the collapse in oil price really to stock up their inventories, 90-day cover or whatever it is. What's your outlook for this capacity of Asia, India and China in particular, to take advantage of this moment?
India doesn't have a lot of strategic reserves, as you know. It's kind of, you're talking about 30, 40 million barrels. So it's got deals with UAE, for instance, to store that oil, Iraq in some of that oil. So if anything, India will continue to just run the Russian oil in its refineries. China, on the other hand, like you said, China alone over the last 2 years has built 216 million barrels of strategic petroleum reserves and, more importantly, commercial petroleum reserves, so CPR as they call it. Huge amount of tank space available. And barring the last 2 months where we've seen a bit of an uptick in Chinese stocks because of low demand, they've run down pretty much all the inventory they've built in 2020, and Chinese crude stocks overall are at very low levels. So yes, we do expect China to step in and buy some Urals in particular, discounted crude into their SPR, because the problem for China is that for taking Urals, it would need to back out Saudi, Iraqi, and other Middle Eastern crude. And our understanding is that China doesn't necessarily want to do that. These are long-term relationships they have with the region. They'll tinker at the margin. Of course, you're allowed 10% allowance in your contracts, but it's not going to be much more than that. So China will struggle to take advantage of Urals discount like India is, for instance, because the teapots in China tend to prefer ESPO so-called rather than Urals. That's not their base load demand. So that's why China will probably use its SPR to an extent to store this oil. However, again, I will note that unlike Iranian oil, which it took back in when Iran had sanctions, Iran is a baseload oil for China. Urals isn't. So there will be limits to how much they would want to fill its SPR. You don't want to fill your SPR with a crude that isn't your baseload crude after all. But yeah, they will take advantage to an extent, but it doesn't mean that you're going to get 200 million barrels of Russian oil into Chinese SPR.
So where do you think that leaves your outlook, at least for oil prices? We've seen them sort of stuck in this range, 100 to 100 now, 12, 13, whatever. So the top end seems to be creeping up of this sort of $10 range for the last 2 months. But where's your outlook for, given all of those dynamics, for crude oil on Brent in the next 3 months?
I would say crude is going to continue to move higher in the next 3 months. The biggest reason above and beyond everything we've spoken about is actually refining margins. We are really constrained on refineries globally because China has changed its export policy, isn't exporting as much, and we've seen nearly 3 million barrels per day of shut-ins in the West. And because we had maintenance season, crude came under pressure. But now with, sky high margins, refiners are coming out of maintenance and running and buying more crude. So that's why you've seen that top end creep higher. So we will continue to get that. You're seeing that in the backwardation in crude, Brent, Dubai, WTI, very, very steep. $3 backwardation pretty much each spread. Again, sending a very clear signal that the market is tightening up. Now, the challenge is going to be in the backdrop. You still have these, or rather, you're starting to get these recessionary fears. And yes, product prices, outright product prices. Look, we've called for crude prices being above $100 between 23 and 26 pre-COVID, right? Because that's fundamentally driven by the lack of investment on the supply side. But the product prices have even outperformed crude prices because we have a shortage of refining capacity. So, we've called for $150 oil this year, and we've had that already because that's ultimately the product price that you and I pay. And I think that's where these recessionary fears are coming from. And you've seen US Fed raise interest rates. That is at the margin going to have a negative impact on sentiment. Now, I'll reiterate
before we get too macroeconomic, I just want to get into that sort of refined space. And obviously, we're seeing a massive differential between crude and products. Do you expect when the refineries come back out of maintenance season that those spreads will come down slightly, significantly?
Slightly is exactly the word, because what we are going to get is we are estimating about 4 million barrels per day of refinery runs coming back, say between now and August. That's plenty of supply, but demand pretty much matches that. Like demand is going to grow by about 3.8 million barrels per day. So the difference isn't very much. So most of that is going to go into absorbing the demand growth that we're going to see. But yes, so compared to the sky high record crack levels that we've seen, products will come down a little bit at the prompt. Crude is going to gain, and that's something we've been saying since early May, that crude is going to gain some of the share of these sky high refining margins. But if you look at product cracks down the line, like say, let's say even December, margins further out, they are heavily backwardated. So forward cracks and margins will roll up. Not to necessarily where we were a month ago, but it is too low. Ultimately, we are still constrained on refining, even though we should get Al Zour in Kuwait starting up in the coming months. Jazan in Saudi Arabia is ramping up, so it provides a little bit of breathing room, I'd say. So yes, we should get product prices come off slightly. But it doesn't mean that, we're going to go down anywhere close to where we used to be in the past few years.
Why do you think, one of the potential solutions, at least on to ease a little bit, would be for China to increase its export quotas on products. They seem to be resisting that, what seems like a big win economic opportunity. What's your insight on that?
Look, I was in Singapore just last week, met with all our Chinese counterparts there as well. And I'll say one thing, every refiner said this policy isn't going to change. This policy is tied to Xi Jinping's policy around reducing emissions. China included refineries as a part of its energy intensity reduction target for 2025. Yes, it's moved back a little bit on coal, on some of the metals, but these are more short-term tactical moves because China at the same time absolutely doesn't want blackouts. But refining doesn't fall in that category because ultimately, if you think about refining, they're not saying don't refine. They're saying refine for the domestic market. Yes, there's a little bit of an imbalance. You can export that, but they absolutely don't want, particularly the teapots who've been evading taxes and are not necessarily in favor with the government. These are the smaller, tiny refineries I'm talking about. They don't want them to just pollute the skies in China and export the product. So this is a huge shift in policy because the West, refineries in the West have been shutting down because China had been, flooding the market with products, taking market share from US and Europe and Latin America and Africa. And pretty much overnight last year that changed. And then because of COVID, we've had 3 million barrels per day of shutdown and because of poor margins as well. Now, the bigger challenge is you've got ESG mandates. If you think about the announcement you got from Lyondell in the US, $60 margins, and you've still got refineries shutting down because on a refinery level, from an ESG point of view, emissions is such a punitive measure. Like as a refinery, if you want to meet any of your ESG targets, it's very hard to continue investing, and you will probably get more refinery closures. So in general, refined products will remain tight for the foreseeable future.
Well, that's a pretty comprehensive overview on the supply of crude and products. Where I suppose the question is, growing in the market has its moments where it soars to the top of the pile and then drops away again, is the potential of demand destruction.
Yeah.
We have this week Davos meeting, a lot of statements being made about the uncertain economic outlook. The ECB has declared now they are going to follow the Fed with rate rises. The potential that this sort of tightening period could trigger recessions and so forth. How do you see the outlook for demand destruction, principally in the OECD?
Yeah, I mean, and that's kind of what we were talking about just earlier, even with regards to the crude oil price. I think that's what's going to cap crude. Fundamentally, we will continue to rise, but that fear about a recession, and that's already starting, right? Like with the Fed increasing rates, as you said. But a couple of things on that. First and foremost, oil prices tend to fall 6 to 12 months after the end of a Fed rate hike. You can go back over the last 40 years and chart this, and it's an impressively correlated chart. We are nowhere close to the end of the Fed rate hike cycle, right? The market's expecting 3% Fed rates in the middle of next year. That's nowhere close to ending a rate hike, right? Given where inflation is. So that's one thing. Second thing is that OECD. So we are expecting Europe and US to be in a recession next year, second half of next year, but not this year. You still have some pent up demand. You're seeing some signs of stress in the very low income level groups, but overall, there is still, if you look at the earnings season, some were weak, but if you look at like Home Depot and those kind of big companies, they are still sending very, very strong results and saying that consumer spending remains very high. But I know you asked about OECD, but the one point I will make, and having been in Asia myself, Asia is about 18 months behind the reopening when it comes to the West. And there is so much pent up demand. Like, I have never, ever paid so much for taxis in Singapore in my life. Right. And you're looking at 40% increases in mobility versus 2019 levels in Indonesia, Malaysia. So that's where we don't think we are going to get a global recession next year, but an OECD recession is likely.
Even with the burden of higher rates on dollar debt and obviously food prices and so forth.
Even with that, for the simple reason that so much hinges on China. Now, I'm not saying China is going to get rid of its zero COVID policy. If anything, it's probably going to continue with this till the party Congress. However, there is pressure on China to start opening up, right? And a big part of the Western recession and the struggles, let's say for an auto company or a lot of companies, stems from the supply chain issues. Now, if China does open up, even if gradually, like we don't even think China will open up to the world before the end of next year. But even if domestically it can open up, a lot of the supply chain issues in the West will ease. Now, will the burden of high dollar and high food prices ultimately lead to a pretty significant recession? We absolutely believe that. But timing it is hard because we've got this pent up demand, which tends to last for about 18 months. So 2024 could be a very bad, very bleak story, because ultimately what we are also seeing in the East is governments are subsidizing everywhere. So the consumers are not facing the true price of oil. And I think that's why you've got this demand growth that we're still seeing. But at some point, you can't keep printing money and kind of sustain this. And I think that's where the China reopening is so crucial, because at least if the supply chain shortages ease off, then we can get a recession globally, but it won't be as acute, because if that still persists, late 23, 24, the picture looks very bleak indeed.
There is the other equation, and we can't really get into it right now. It is when Europe and Asia starts competing for energy, I think it starts to trigger a whole nother layer of challenge for Asia. But I wanted Marita to finish on OPEC, OPEC plus. We've had some words this week or some commentary, the start of the Saudis indicating that they want to renew or sustain this agreement. Of course, OPEC plus agreement expires in September. In all realities, it's pretty much over anyway, because they're maxed out in their production capabilities, bar maybe Saudi and the UAE, and even there they may be reaching it. But I'm wondering your thoughts on the significance of OPEC Plus going forward. What's its role? How important is it that it does renew or it doesn't? Your thoughts?
I think, look, OPEC Plus have done a fantastic job in terms of managing what has been anything but an easy market, right? It's been so turbulent from COVID to now Russia. I mean, everything. They've been steady. But yes, a big part of that is a lot of countries just don't have the spare capacity. Even if they wanted to, they couldn't raise production. I think both sides, like, I mean, even Russia with all the struggles they face, but of course, Middle East and OPEC countries, none of them want to see this deal just expire and then suddenly it's free for all. That's something that's come up in my conversations with pretty much all the key stakeholders, that they want to keep some semblance of a deal going. Doesn't mean it has to be 430,000 barrels per day every month. It could be a higher number. But again, to your point, there'll probably be only 2 or 3 countries that could actually deliver that, right? So the others are going to struggle anyways. But they are still very, very scarred by what happened in April 2020. They understand that things could change on a dime, especially now with recessionary fears. They still think Iran is going to come back to the market at some point. So and now, of course, you've had headlines on Venezuela as well. So these things just it's kept the group together. And regardless of how much pressure there is, yes, UAE wants to increase production, but as a group, they still want to make sure that there is stability in the market. I think that's their number one objective right now, which means
there
that
is
the
that
deal will
point.
continue.
The deal will continue, yes, but the stability relies also on credibility. Christine Lagarde yesterday in her statement with head of Davos saying that one of the reasons of the many has been OPEC Plus's failure to meet their own
Quotas.
commitment, right? Their own quotas. And so in rolling into something new, your thoughts on how they, or do they need to get that alignment back? They've got quotas at the moment that are unaligned to the reality and so consequently not credible. How important is it, no matter what they do going forward, that they remain credible?
Oh, credibility is super important, but that's where politics also comes in, right? What you are essentially saying is Saudi Arabia and UAE should be given bigger quotas because they can produce. But why would anybody else accept that, right? Because remember, they think longer term, and for anybody to accept that means in the future, when you have quota negotiations during a downturn or an upturn, that becomes your starting point. And that's why it's always been difficult to have any quota negotiations. I think that's the challenge that OPEC Plus will face. But I will say one thing to Christine Lagarde's comments is that, sure, it's easy to point fingers at OPEC, but the crisis we are in right now is absolutely the Western world's doing. The Western world keeps talking about energy transition without paying any attention to energy security, or for the simple matter, accepting that oil demand, gas demand continues to grow at a rapid clip. There has been no reduction in, like, structurally in terms of demand growth, and yet we've killed supplies because of energy transition policies. And then, at the same time, the West is asking OPEC Plus for security of supply. I think OPEC Plus has every right to turn around and say, hey, where's our security of demand? If you're going to clap, it needs to be with both hands, right? And I think that's where the West, I mean, this where we are today is absolutely Western policy failure. Sure, OPEC Plus could do tweaks at the margin to increase production, but then you get into the minutiae of it. Structurally, that they are not to blame for where we are today.
Clearly not. And I would add to that, and for the sake of another conversation another time, is the West, and particularly Germany in this instance, addicted to cheap energy. And now they're facing the reality of what energy really costs when you have to move it around a little bit further. Amrita Sen, founder and director of research at Energy Aspects, thank you so much for being on Halftime Talk this week. Really great to have your insights.
Thank you for having me.